Hey everyone, today's video is for the value investors out there. I am going to cover 3 dividend stocks that I believe are deep discount values right now. I'm going to go through each of them in great detail, and I own all 3 of these stocks in my personal dividend stock portfolio, and I am thinking about adding to certain of these positions as well. I am talking about Wells Fargo, ticker symbol WFC. I am talking about Altria, ticker symbol MO, and I'm talking about PPL Corporation, ticker symbol PPL. I own all 3 of these. Right now, all 3 of these companies offer really compelling dividend yields. And for an investor like myself who is looking towards the long term, has a long-term time horizon, all 3 of these, in my opinion, appear to have really compelling value right now. Quite frankly, in a market where everything else is trading at premium levels. Out of the 46 stocks that I own 46 dividend stocks. If you've been following me, you know the ones that I buy on a weekly basis, right now at least, are trading at fair valuations. There is very little discount out there. There's very little value out there. But with these 3 stocks, in my humble opinion, these are some of the hidden gems, the hidden value that is out there in the stock market right now. And of course, they are values for a reason, because all 3 of these carry more risk. They carry increased risk as compared to the average types of positions that I own, the positions that I talk about on this channel all the time. But sometimes as an investor who is building a portfolio or who has a large portfolio, each stock plays a role. And sometimes even in my own portfolio, I like to have the ones that have a little bit more risk, but a little bit more reward. So get ready, everyone. Really exciting dividend investing video today. All right, everyone. So I'm going to start out with Wells Fargo today. Before I get into that, I want to just give a quick background on why I am doing this video. I received a question from my friend on Patreon who said, Ian, I want to know what your thoughts are on Altria. And I not only want to know about those thoughts, but I want to know, how did you kind of approach Altria, or how would you approach Altria, hypothetically speaking, if you were starting over and maybe you were younger in your investing career, you were willing to take on a little bit more risk? And so that kind of got me thinking. These days, I'm further along in my portfolio. It's more established, don't need to take the risk. And so I'm typically investing these days in the blue chip names that are not on great value, but that's okay because I'm looking multi-generationally. I'm looking into the future. But it got me thinking, hey, hypothetically, if I were younger, if I were starting out again, hey, when I did start out, I was really heavy in sin stocks. Most of my money was in Altria and its peer group stocks. And so it got me thinking, well, if I were doing this again in 2020 and I were consciously looking to take on risk, hypothetically, 3 stocks that come to mind that are very reminiscent of Altria, and another one was Reynolds American when I first got started. Yeah, these 3 are reminiscent, and so that's why I want to go through these 3 today. Again, it's for the value investors out there. I hope you enjoyed the video. And before we even get started, if you like value investing, you like dividend investing, you like investing for huge dividend yields, please hit the like button, give the thumbs up to this video. It is a great way that you can thank me for producing this content here on YouTube. And so check it out on the screen right now. I want to share some stats about Wells Fargo. And so the first thing worth noting is my cost basis is really high. I started buying Wells Fargo before this global pandemic, and I started buying it in January, February, and March this year in 2020 before the global pandemic. And at that time, my cost basis was higher. It was at $47.85, and now the price per share is all the way down to $25.47. And so I am down 47% on this stock. It is one of those stocks where I could have never seen this global pandemic coming. And obviously, before the pandemic, even in those mid and high 40s, to me, it seemed like a reasonably priced bank stock, and a good bank stock, one that had been emerging from a series of scandals. The biggest one that was in the headlines all these years was this fake account scandal. And so Wells Fargo, before the pandemic, was just starting to get out of all of that drama. And then they got slammed with this pandemic. They just got slammed. And I think they are preparing at this time for being a community lender, being a company that does a lot of home loans. I think they're preparing for loan losses. And I know they're already increasing reserves, if you will, and preparing themselves for loans that are not going in their favor. And so with Wells Fargo off the bat, when I see a position of mine that is down that much in that short of a time, it gets my attention. It gets my attention. And I'll just say off the bat, it's not part of my core charter right now. It's not part of my charter. I really want to stick on my ride or die stocks, but at the same time, I will probably nibble. I will probably take a small bite out of Wells Fargo just to add more to my portfolio, because when a stock I own and I never sell is down this much, if I don't buy when it's down this much, I'll just regret it. The Ian of the future will regret it. And so I don't even have to look further. I've already done all my due diligence. I already know it. I already own it. If it's down this much, I'll probably go ahead and just buy a little bit. Again, I don't want to go too crazy because I'm really focused on my core quality companies these days. But again, this is one of those values that personally I just don't want to pass up. And so I want to move on now. Check out the numbers on the screen. And I want to talk about the dividend. So the current dividend is 51 cents a quarter, or 204 a year. The dividend yield is just over 8%. Now, this dividend yield I highlight, it is fabulous. The way I look at Wells Fargo right now is that this dividend is going to go away. And so my understanding is the Federal Reserve is going to impose certain rules, if not already, on banks. They have new calculations on how much of a dividend large banks in the United States can pay out during this economic crisis and pandemic. And they're doing this to bolster the banking system, to make sure that the banks do the right thing, that they don't just squander their money and put our entire country at risk. And I think the Federal Reserve has learned from the Great Recession and from the crisis of 2008, 2009 to be smarter this time around. And so they're imposing restrictions. Long story short, Wells Fargo is expected to cut the dividend. They're going to do it. And so the way I look at Wells Fargo is it's not the kind of stock at this time that's going to pay any kind of meaningful yield in the short run. I wouldn't be surprised if the new yield gets adjusted from an 8% down to, say, a 3% range, maybe 4% range. That's what I'm expecting. But the way I look at it is fast forward 5 years from now, certainly 10 years from now, when things get back to normal, I think that 8% yield that we're seeing right now will be back. It will resume. They will increase the dividends. It will get back to where it was before. And so as a long-term investor, I'm looking at it as an 8% yield. I know I'm not going to get the 8% yield in 2020, 2021, probably 2022. But by the time 2025 comes around, or 2026, I'm looking, hey, what I'm buying now in the $25 range will probably be yielding 8%. And so off the bat, that really, in my opinion, that's a thug life move. That's an exciting, compelling investment. Certainly contains risk, but the promise of the 8% yield, because that's what it was doing. It wasn't yielding 8% because the share price was higher, but the raw dividends going out, it could fully support that just earlier this year, just in January, February, before this pandemic hit. And the pandemic alone has caused all of this drama for the company in the short run. But there is no doubt in my mind that they will get back. They will figure it out in the coming years. And so that's the first thing I want to point out. I also want to point out that the EPS is horrible. 2020 is going to be at 71 cents, 2021 at 240. And so in both years, the payout ratio is horrible. 2020, 287%. 2021, 85%. PEs are horrible. 35 for 2020. Although 2021, that's not bad. It's a 10. And so Obviously, in the next 2 years, the dividend is not going to be supported at these levels. But quite frankly, even in looking forward to 2021, PE of 10, it's not bad. It's already getting back on its feet. Now, what I do here is I also highlight that the dividend has been growing over the last 5 years. The average annual growth rate of the dividend has been 6.3%, which is great. It's just below the 7% that I typically target, so it's not bad. No doubt that will resume once this pandemic gets passed. And like I said, the way I look at this is I'm kind of locking in an 8% yield, but I'm locking it in a really risky way on the hopes and the belief that looking out a few years, it will be back to normal. And so that's why I look at it kind of as a deep discount value. Now, to hammer that point home, though, I have something else on the screen right now that I want you to look at, and I want you to look at my look back. I did a full analysis of this stock just back in January, and I'm going to share a link to that in the description below. It is a really lengthy analysis. I looked through all kinds of different banking specific metrics, and I proved to myself why out of all the banks I really liked this one. I thought it was the best value play, and I was looking for a value play in the banking sector in my portfolio for a long-term buy and hold forever position. And what you see is at the time I did that analysis, the actual EPS in 2019, this is real, this is what they earned in 2019, was $4.54 per share. 2020, it was being estimated a little lower at 4.31. And so what's so fascinating is if we look at the current share price is $25.47. If we apply what they actually earned in 2019 to that, it's as if it's trading at a PE of 5.6. And if you apply the 2020 EPS that they were expected to get before this horrible pandemic, it was a 5.9 PE. Those are the metrics I have here at the bottom highlighted. And so again, going back to my point, the way I look at Wells Fargo now is at the current prices, at these deep discounts, there is risk in the short run. This bank is getting hammered due to the global pandemic and the economic crisis. But if this bank can get back to normal, if society can more or less get back to normal in the coming years, I would not be surprised, quite frankly, if we do, because a lot of folks these days are starting to move out of some of the big cities into the suburbs. A lot of first-time home buyers, younger people finally trying to settle down and have roots and buy their first home, for example. Wells Fargo could be perfectly positioned for this, and if they can just get back in future years, say 5 years from now, to where they were in 2019, the way I look at it is at current prices in the $25 range, I'm getting a PE on cost, a future PE on cost in the 5 range, and I'm getting a future yield on cost in the 8% range or thereabout, and that is why I look at it as a really compelling value. Now, also on the screen, what I'm sharing are some notes. And so why is this thing a value? Well, first, as I mentioned, they're going to be cutting the dividend. The Federal Reserve has rules now in 2020 for banks around dividends, and they're going to have to cut it. They are already increasing their allowance for loan losses. This is one of the reasons that their earnings are so poor recently and that they're expected to be so poor this year is they're increasing that allowance for loan losses. I think they think there's going to be some pretty big loan losses this year, hence the forecasted EPS this year of only 71 cents. What's also really hard is banks grow by increasing assets, and they increase assets by making loans. And so the challenge with this company in particular is the Federal Reserve has an asset cap on the bank. Because of the fake account scandal, they still, to my understanding, have an asset cap. And the Fed is basically placing this cap on Wells Fargo that keeps it from growing. And from my understanding, in a low interest rate environment, in the type of environment we're in now, by having this asset cap, it really penalizes the bank. It makes it really hard for this bank to earn money. But you know what? At a certain point, the Federal Reserve will lift this asset cap. It will be out of the way and it will be gone. And this thing that's artificially holding this bank down, it'll be gone and they will be ready to resume operations, get back to normal. And quite frankly, they were already earning $4.54 in 2019, even with this asset cap. So imagine what they can do without the asset cap. And perhaps the opportunity for a PE on cost could be even better than 5. It might be in the high 4s, for example. And so that's something that I look at as one of the reasons that it is trading really low and one of the reasons that the numbers are bad, but it's also a reason for a turnaround play, for a deep discount value type of stock. And so that's compelling for me about Wells Fargo. What else? They cut thousands of jobs this year, at least they're forecasted to. Stock was actually up on this news, but that is another indication, hey, the company is just not doing that well right now. They're going to have to cut jobs. And also, Warren Buffett's company, Warren, please picture me rolling, they cut their position back. And so a lot of investors look at that as a negative against the company. Personally, I look at it as a positive. But anyways, that is some of the negative news with Wells Fargo right now and some of the reasons that the bank is struggling and that the bank is facing challenges. But another way of looking at this is the market cap right now for Wells Fargo, just over $100 billion. That is really low for Wells Fargo, just in the historical context of the company. And so again, there's a reason it's on discount right now. Am I going crazy? Am I going to buy a ton of shares? No, I'm not, because I have to focus on my charter for this year, and my charter for this year are my ride or die positions, my bread and butter, premium quality stocks that I buy day in and day out. That's what I'm doing because that's where I need to go, given where I'm at in my journey. That being said, I probably will buy just a little Wells Fargo because, like I said, if I don't buy it, I'm going to regret it at these prices. And again, hypothetically, if I were starting over and I were seeking a little bit more risk, like I did in my early days, I went real heavy in sin stocks. Most of my money in sin stocks helped me out, kind of catapult my dividend investing success by taking a little bit more risk. If I were kind of in that mind frame, Wells Fargo would certainly be a position, hypothetically, that I would be taking a closer look at even than I am. And so with that, I want to move on to the next stock today. I'm actually going to go into PPL Corporation next. I'll do Altria last. So check it out on the screen right now. I want to share PPL. So I got some cool metrics to share. And the first thing that I want to show is the price per share is $25 and change. My cost basis is 31, so I'm down 19%. And I'll share a link in the description below. I started buying PPL pretty recently. It's been within the last year. It's a regulated electric utility. I really like it at current prices. They do business in the United States and in the UK. I'll talk about the UK in a minute because that's one of the reasons the stock is down and facing pressure. But check it out. The dividend, this is my favorite thing about PPL, is 41.5 cents per quarter, or 166 a year. The starting dividend yield is a 6.57. 6.57. I believe that dividend will be maintained and probably increased slowly over time. And so again, really compelling. The stocks I'm sharing today, quite frankly, are high yielders. These are high, deep discount value type of plays. And again, Wells Fargo, it's more of a future yield because that dividend is going to get cut in the short run. PPL, quite frankly, is a yield right now. It's a current yield, and it's a great 6.5% yield that investors can enjoy right now. So what's not to love about that? Now, the EPS is estimated to be $2.43 this year, $2.44 next year, so not a lot of growth, but that places the PE in the 10s. And certainly, for me, I like a regulated electric utility like this quite a bit more than the folks over at Dominion that just cut the dividend. Is just a terrible tragedy. Affected some dividend investors out there. Heart goes out to the community if you own Dominion. Hands down, I feel really good about owning PPL. I don't think they're going to face a similar fate to Dominion, but you never know because I'll get into some of the risk factors in a minute. But PE's in the 10, love it. But again, PE is in the 10 range for a reason. We'll talk about it in a minute. Payout ratio is a healthy 68%. Dividend growth rate, compound average growth rate per year is only 2.2%. So not a lot of dividend growth, not a lot of EPS growth, but the yield is solid. And getting a solid 6.5% yield in this interest rate environment is awesome. Smaller market cap of $19 billion, so it does have opportunity for this thing to get acquired. Hopefully that doesn't happen. I don't like it when my companies get acquired. I like to buy and hold forever. All right, so what I want to do with PPL actually is I'm going to share on the screen right now. Check it out. This is a table that PPL has from their earnings report. And one of the things that you'll see here, this is from their 2019 earnings report, their 10K, their annual report. They have three businesses. They have UK regulated, Kentucky regulated, Pennsylvania regulated. So the first thing you see is just look at the UK. 977 million of their total net income. And in fact, if you do the math on that, that is 52% of net income. So 52% of their net income does come from the UK. And what you also see on this screen is the margins are really high in the UK. They bring in 977 on only 2.2 billion of revenue. But you compare that to Kentucky and to Pennsylvania, the margins are significantly lower. In the U.S.-based business, it looks like the margins are half as good, if about half as good in Pennsylvania, and even worse in Kentucky. And so that's something, if you just eyeball the numbers here, you see the UK drives a huge portion of their business, and the UK margins are really compelling. And this is what originally drawed me into this stock. You'll remember from my original analysis of PPL, which I'll link to in the description below. But what I want to share on the screen right now are some reasons, some risk factors why this thing is deep value. Because typically in the stock market, there's no free lunch. When a stock is traded at a low price, there is something going on. And as a value investor, when I'm in kind of at my deep value thinking cap on, and I'm thinking about deep value, I have to assess, well, what are the risk factors, and do I believe these risks are going to pan out? And I have to price the risk. The market prices the risk. I think with Wells Fargo and PPL and Altria, for that matter, I think the market is overpricing the risk. But certainly, I do believe there is some risk there, and that's why they're on sale. But the news with PPL is in the UK. By the way, if you're from the UK, shout out, London, it is my favorite city in the world. Please put in the comments below if you're from the UK. Give it a thumbs up. The videos support the UK. I love the UK. It's one of the reasons I invest in this thing, one of the main reasons. And also share in the comments below your experience with UK politics, because I know politics in the UK with Brexit, with the elections last December, it's been very controversial, kind of like it has been in the United States. And so I'd love to learn more about UK politics. But my understanding of why this thing has traded down so much in recent years is because of the Labour Party. Apparently in the UK, there's a Labour Party. And the Labour Party, my understanding is it's kind of like the Democrats, I guess, in the United States, but maybe even a little bit more democratic, maybe more like the really kind of liberal Democrats that are in the United States. Some of the kind of folks talking about like Green New Deal and that type of stuff. That's my understanding, but I could be wrong. I don't live in the UK. But my understanding is what the Labour Party was saying is, hey, we want to nationalize all the utilities in the UK. They're basically saying we want to have state-run utilities. We want the government to run the utilities. And then so you start thinking as a PPL shareholder, oh boy, half of the revenue is at risk, or half of the earnings is at risk. The high margin part of the business is at risk because the UK government is saying, we want to nationalize this. Now, thankfully, what happened in December, my understanding is the election happened and the Labour Party basically lost out to the Conservatives. My understanding is the Conservatives got most of the power in the government, and in doing so, it puts PPL in a better position. It puts PPL in a better position. Certainly, if the Labour Party had won out in like a radical landslide type election, it would be very bad for PPL. But the thing is they still have stuff going on. By 2050, there's a zero emissions target. There's a lot of talk about utilities right now in the UK. And again, 52% of PPL net income comes from the UK. And so I think Boris Johnson, for example, he might be under some pressure to really think about utilities critically. There's been a lot of heated debate in the UK about Brexit, about what comes in the future, about what is the future of the country? And so I'm probably not doing this justice. My understanding of the global political environment is not very strong. And so I'm just going to be very clear on that. I hope I'm not embarrassing myself. I'm doing my best to just share my very basic knowledge of what's going on here. But long story short, my understanding is PPL avoided a really kind of knockout punch type scenario. That being said, their UK business, it's still not all, green light ahead, up and to the right. No, there's a lot of critical thinking happening in the UK about what is to come for the utility landscape. And obviously this places PPL at risk. But again, I think at a PE of 10, that risk is priced in. I think the fact that the Conservatives won out the election is a good thing. So share in the comments below if you feel the same. Personally, I really like PPL here. I only have so much money to go around in terms of what I'm deploying, and I don't want to get too much away from ride or die. So as I think about these stocks, certainly I'm reinvesting dividends in PPL, Wells Fargo as well. But I'll probably, the capital I do have to kind of allocate to these more risky stocks, I'm thinking Wells Fargo for me versus PPL, and I already have a little bit of a bigger allocation to PPL anyways. But I like PPL here from that kind of risk-adjusted viewpoint. But again, it does not come without risk. 6.5% yield, 10 PE, it does not come out without risk. And the risk is in the form of what's going down in the UK. So moving on, I want to share the third and final stock today, the Thug Life stock, Altria, ticker symbol MO, one of the first stocks that I bought when I was building my portfolio as it is in its current state. I love this stock so much, so I'm going to share on the screen right now some metrics. And one of the things that I want to share first is, man, I started buying this thing back in 2009 at $15.99. Those were the days. And so anyways, right now, though, it's at 40. The dividend per quarter is 84 cents. It's $3.36 a year. Dividend yield is 8.34%. I highlight this. This is an 8.34%, quite frankly, that investors get to enjoy now. I don't think they're going to cut the dividend. I don't think the dividend is at risk. They have mentioned in all of their reports that the dividend is very core to them. It's very important to them. It's a shareholder-oriented company. This is the kind of company I like to own. I like to own companies that reward me as a shareholder for sticking with them and for investing in them. That's how it should be. And so in terms of EPS, they're expected to earn $4.26 this year, $4.51 next year. PE is at a 9.5 this year, 8.93 next year. Bargain basement territory. It does not get much better than that. I love this so much. It's perpetually on sale because for whatever reason, the political landscape, I think just the way people think these days, there's a lot of risk being priced into this stock. I think more risk than there really is. But anyways, that's how it goes. It creates opportunity for deep discount value investors. And I can't call myself that, quite frankly. I am that some of the time. And you've known from some of the videos I did here, when AbbVie was on sale, I went all in deep value, and it panned out really well. I did the same with General Mills. I did the same with Campbell's Soup. And so when I see deep value, I go for it. And quite frankly, this is one of the reasons I don't own an ETF. I own individual stocks because certain stocks out of the 46 at any given time are on sale. But all I'm saying is I'm not a pure deep value type of guy. It has its place in my portfolio. I do it. But I'd say on average, I'm a more balanced investor who has a bias towards value, but also has a bias towards pristine quality dividend growth stocks. Anyways, with Altria, check it out. The payout ratio is a healthy 79%, as 75% next year. They've been increasing the dividend on average by 10% per year. I don't think this will continue. This is a little higher probably than it will be in the future, but that is simply stunning. It's just fabulous. I mean, for example, if you take the my first tranche, which is at $15.99, and I look at the dividend yield on that, I take the $3.36 and I divide it by $15.99. My simple yield on cost for my first tranche is a 21%. That's what's possible with something like Altria. That's why I went heavy on deep value when I first got started. That's when I was an earlier investor in my career, I took a little bit more risk because I ran the numbers and I knew what was possible when I bought deep value. Deep value carries more risk, but at the same time, at that time in my investing career, it made more sense to take on that risk. And so with Altria, what I want to do next is I also want to look into some of their financial statements. So check it out on the screen right now. I want to share some cool stuff. And so the first thing that I want to do is I want to share their earnings report that came out recently. This is from Q1 of 2020. And what is so fascinating is the thing I love the most is net revenues are up 13% year over year. Everyone complains, hey, this is going out of favor. Living here in the Bay Area, people kind of look down upon it. You know, they almost think, hey, I don't want to get into it, but you know how it goes. But anyways, oh, this is a business that's going away. Nope. Revenue is up 13%. Picture me rolling. And so, to be fair, one of the reasons for that is because of the pandemic and because people were kind of uncertain of supply chain and such. They were stocking up. People were stocking up on their products because they were preparing for whatever was to come ahead. And certainly that makes sense to me. And so I don't expect revenue to be accelerating this much in perpetuity, but it sure is nice to see it right here in Q1. And Q1 is just when this whole thing was starting. I think Q2 will be even more interesting. But anyways, what you also see on the screen right now is the adjusted diluted EPS is up 18.5%. The reported EPS is up even more, but I don't want to look at that too closely because there was a bunch of wacky stuff going on with the Jewel acquisition, with certain write-offs that they were taking, write-downs, impairment charges, if you will. And so numbers can get wacky on that. So I look at adjusted diluted and the earnings are following the revenue. But because I know so much wacky stuff is honestly happening with the earnings these days, and because I know that their margins are about the best margins of any company, I'm not too concerned about the earnings as much as I am with the revenue. And so to see the revenue doing so well is compelling. And so that's the first screenshot. Now, the second screenshot I want to share right now, check it out. This is from their annual report last year. And what I'm sharing on the screen right now in their annual report from last year is a snapshot of their balance sheet. And what I'm sharing from the balance sheet is actually just the liabilities. And in particular, I'm contrasting the very strong earnings that they have with a balance sheet that is not as pristine as it once was. And so you think, Ian, Wells Fargo, it's down because, man, they're just getting slammed by this pandemic. They have an asset cap and they're coming out of a scandal and they're cutting the dividend. They got a lot of bad stuff going on. PPL, they got to deal with some crazy politics in the UK where they're trying to nationalize the utilities. And so, and I want to get down on my UK friends. If you're watching and you support the Labour Party, hey, I don't know enough about it to even comment, but it just sounds like, man, please don't nationalize it. Please don't. And so I see that risk. And now, what's the risk with Altria beyond the obvious that, oh my gosh, they're in an industry that everyone hates? But it's so funny in the context. 2020, everything flips around and you start thinking, are the things I'm even calling a sin stock the sin stock, or is other stuff out there much more of a sin? That's how I'm looking at it these days. It's so funny. But anyways, with Altria, one of the big reasons it's trading down is because of what you see on the screen right now at the balance sheet. And the balance sheet shows, long-term debt, it goes from $12 billion in 2018 up to $27 billion in 2019. Now, thankfully, their overall liabilities only increase here by about $2 billion. And so it's interesting to see that they're making up for it somewhere else. I guess their current liabilities are down. Well, I guess it seems like in even 2018, there was a big short-term borrowing. And I bet you these short-term borrowings, again, perhaps they were gearing up for these acquisitions. It was related to these acquisitions. Long story short, debt at this company has become a lot worse than it was. And you see it showing up there in long-term debt. And why is that? They bought this company called Kronos, and I think that is smart, getting into the cannabis space. I like that. I think that is good. I've heard that it's not necessarily the best acquisition in the space, but I think if anyone is positioned to figure out the distribution of that space when it does become legal in all of the United States, it probably is Altria. So I think it's smart for them to have a foot in the door in that industry. And then the other acquisition they made of Juul is a complete debacle. It was an awful acquisition. Did not work out well. But it's kind of like when I bought Wells Fargo before the pandemic. I couldn't have seen it coming. And I think with these guys, they couldn't have seen what was coming with Juul. Basically, Juul became this horrible scapegoat for an entire industry of vape. And science even proved that it wasn't Juul that was at fault for what had gone down, at least according to what I had read. But nonetheless, because they're the big company with the big brand, they got attacked for it. And of course, I don't want to seem insensitive. My heart goes out to anyone affected with any kind of health issues as it pertains to these adult products. And so, again, my heart and prayers go to anyone in that situation. It just happens that for me, at least, I believe that when Altria bought Juul, they couldn't have foreshadowed what was to come. They couldn't foreshadow that they would become basically a target. They'd have a big target on their back of the entire industry, and that they would be under attack from the FDA, from the government, from all kinds of politicians, from all kinds of attorneys. And long story short, if anyone else made this kind of debacle and had this kind of misfortune, it would put a lot of companies out of business. But because of the strength of this business, they are still doing just fine. And with that, I want to share back my screen again that shows all of the metrics of this company, because I want to go in here and discuss what is some of the news, what's going on. And so there's some good stuff. IQOS, this is a heated product. It heats the product versus burns it. And the beauty of IQOS is it's taken off in Japan. Now, in the United States, they now have authorization to sell IQOS. And also, they just recently, last week, got approval from the FDA to market IQOS as a reduced risk product. I think that, and in fact, they said in the tests that they've run, more than half who have tried IQOS as a test, they've decided to go on and then purchase it subsequently. And so the future of this company, they now have a reduced risk product that they invented, and it is a disruptive product. It is a new technology that could be the future of this company. And so I think that is very strong. It's an innovation that originally came from their Philip Morris International counterpart across the seas, and it's been very, very popular in Japan. And so that's exciting to see. What else? We talked about extremely strong revenue and earnings growth. And here's something else I want to point out. In 2019, adjusted diluted EPS also grew. It grew by 5.8%. So even in the middle of all of this, all the drama this year, obviously it's growing because people are stocking up. But even before the drama, earnings are growing. And it's surprising to people because people look at this as a quote unquote dying company, but not necessarily. The company is doing quite fine. The Juul challenges, in my opinion, some of them are behind, not all of them. They took $8.6 billion impairment in 2019. This is what I'm talking about. They basically took $8.6 billion and flushed it down the toilet. It is just a horrible debacle. But again, I don't think they could have foreseen what was coming. And potentially it still is some opportunity in the long run, but I think there's a lot of challenges in that space. And so that's Altria. I guess the challenges with Altria, again, is it's priced in bargain basement. You get a great yield. It has a great PE. But the challenge with the company is it is a sin stock. A challenge with the company is it now has racked up a lot of debt for nothing. It has this horrible Juul acquisition. And quite frankly, the lawsuits will probably keep coming as it pertains to that product. But at least the company has a lot of experience in that arena. And so all three of these stocks have their issues, but hypothetically, if I were earlier in my dividend career, This is the type of stuff I was looking at all day, every day. And so for me, where I am now, I'm certainly reinvesting dividends in Wells Fargo and PPL. In Altria, I'm not, because I'm trying to take that money and selectively reinvest elsewhere as a diversification play. Of the three, which am I buying now? I'll probably buy just a little Wells Fargo, but I would feel fine buying, honestly, some Altria and PPL here, but I'm not, because I need to challenge myself to put my money in the ride or die premium stocks that I need to allocate towards to build them up to size. I'm talking about stocks like 3M. I took my dividend from Altria last week, quite frankly, and bought more shares of 3M. So that's where I'm personally at in my investing journey right now. And so please, everyone, if you enjoyed the video today, please comment, subscribe, like, give me a big thumbs up if you enjoyed the video today. Also, just so you're aware, I'm now on Patreon. I'll link to it in the pinned comment and description below. Thank you. Bless you for everyone who is supporting me on Patreon. It means the world to me. And the support, it really helps. It really helps. It helps me up the frequency of videos, the quality of videos. It helps me dedicate more time, more resources to this YouTube channel. And so your support on Patreon, it's meaningful. And so thank you. And if you want to support, means the world to me. It's certainly, you do not have to either. Before I leave today, in terms of a full disclosure, I own the stocks mentioned today. I am long Altria, ticker symbol MO, Philip Morris, ticker symbol PM. I am long PPL Corporation, ticker symbol PPL, Wells Fargo, ticker symbol WFC. I am also long Campbell's Soup, ticker symbol CPB, AbbVie, ticker symbol ABBV, and General Mills, ticker symbol GIS. I own all those stocks in my personal dividend stock portfolio. Also long 3M, ticker symbol MMM. I own that one too. And so in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. I'm literally just sharing my personal journey here on YouTube for fun and entertainment. My analysis could contain mistakes. Investing in the stock market carries tremendous risk, especially during unprecedented times like we're in now. Please consult your licensed financial advisor before investing in the stock market. I love you all. Please share your love in the comments below, and I will see you all in the next dividend investing video.